Dicta clases en Lyndon Johnson School, es egresado de Harvard y Yale. Ocupó varios cargos en el Congreso de Estados Unidos, dirigió el programa de PhD en políticas públicas del Lyndon Johnson School desde 1995 hasta 1997. Allí dirige el proyecto de desigualdad de la Universidad de Texas. Galbraith es académico senior del Levy Economic Institute y preside el directorio de economistas para la paz y la seguridad, una red de profesionales a nivel mundial, autor y coautor de varios libros de finanzas y libros de texto.
Muchas gracias. It's a great pleasure, indeed an honor to be here. I do wish to begin with a confession, as the governor has already pointed out to you. I did graduate from Harvard. Please don't throw eggs. I also want to preface my remarks by standing alongside the governor in what she said about the importance of having a broad and flexible mandate for a central bank. There is another central bank in the world which has a broad and flexible mandate, and that is the Federal Reserve Bank of the United States, whose mandate, which includes, among other things, full employment, balanced growth, and reasonably stable prices, is a flexible and pragmatic legal statute that was enacted under the title of the Humphrey Hawkins Full Employment and Balanced Growth Act of 1978, and has served since that time as the governing framework for the U.S. Central Bank. It is something that I know about in fine detail because at the time I was a 24, 25-year-old member of the professional staff of the Banking Committee in the House of Representatives of the U.S. Congress, and it fell to me to actually write the monetary policy provisions of the governing statute of the Federal Reserve. Nobody thought it was important enough to be given to someone more senior. But it has served over the decades since to provide the Federal Reserve with a framework and a mandate that is not as dogmatic as those that have been adopted by other central banks, and notably by the European Central Bank. And I think that fact has actually served the United States fairly well in the response to the crisis. And so I think it's worth noting that as Argentina takes also the path that a central bank should be a flexible governing institution, it is perhaps not in the line of the mainstream of economic thinking, but it is taking a path which has some demonstrated model of success behind it. I've been asked to discuss the origins of the great financial crisis, and let me begin by warning against an analytical trap, which is that of treating these events as a phenomenon with a single dominating cause. There are many explanations that have this character. Talk about the euphemisms like financial innovation, or fairly innocent physical metaphors like bubbles which grow and then pop, or the darker indictment of the role of financial fraud in the underpinnings and the lead-up to the Great Crisis. In Europe, similarly, we hear of the Greek crisis, which is commonly described as a crisis of one country's public finances, or of real estate speculation in Spain or Ireland, or the uncompetitiveness of Portuguese industry. And while each of these has an element of truth, to accept any one of them is, I think, subconsciously to define and to judge the crisis as a shock to an otherwise sound and stable system. And when you do that, you allow yourself to be drawn to the implication that when the crisis ends, first of all, that the crisis will end, and that when it does end, the system will recover. That there will be a reversion to the previously normal condition, to the pre-crisis status quo. And I think, as I say, that this is an analytical trap. To begin to understand the crisis, one has to move beyond that frame of mind. Now, there are alternative perspectives, and they offer us the opportunity of adopting a different attitude, a different frame of reference for these events. The economist Hyman Minsky coined a financial instability hypothesis, which teaches that instability is the natural product of stability, that it grows organically out of the periods of growth and expansion in economic activity, that confidence breeds a reach for yields, an increasing tolerance for risk, an evasion of financial supervision and regulation, and that these things are inherently the building blocks of a financial crisis. The economist Wynne Godley, at one point senior advisor to the UK Treasury, created a sectoral balance approach, which helps us to understand where in an economic system the trouble is most likely to arise. Gives us a clearer understanding that the surplus in one sector is necessarily the deficit of another, and the financial conditions of those deficits are what may well be the precipitating factors behind a financial crisis. And this can be true inside a country with the household sector in the United States, or between countries, between the surplus and the deficit countries of Europe. The principles are exactly the same. So these perspectives tell us that crises are to some extent an endemic feature of the systems under which we live. And I think they are necessary, a necessary corrective to the one cause view, but I also think that they are not entirely sufficient. What we need is to attempt to acquire a deeper understanding of the historical setting, especially in the United States where this crisis did originate, to understand not only what happened, but why it happened where it did, and why it happened when it did. And if we cast ourselves into this particular frame of mind, I think the first thing that we will come to understand is that the exceptional period in modern history, in the lifetimes of some of us, is the period of post-war growth from 1945 to 1970 in the United States, and in the recovery from the Second World War generally, a growth period that was fueled in America by ample supplies of domestic resources, especially oil, and stabilized internationally by the Bretton Woods institutions. And a period which came to an end in the early 1970s as the United States shifted to increasing dependence on external sources of core resources, especially energy. As the Bretton Woods system was dismantled, the dollar devalued, various shocks and crises hit the system, giving rise to the risk, which was understood at the time to be one of import-led stagnation, the opposite of export-led growth. And then, in the 1980s and the 1990s, we seemed to have overcome these problems. And they receded from the front rank of our consciousness in economic policy. Economic growth resumed. And resumed and carried on almost continuously for 20 years in the United States. But on what basis? On the basis, first of all, of an enormous rise in interest rates and the imposition of a crisis of debt and development on much of the rest of the world, which had the effect of breaking the back of high resource prices for an extended period of time, and permitting the United States to move massively into current account deficit, with the dollar, rather than the Bretton Woods system, becoming the reserve asset foundation of the global monetary economy. And then, over the course of the 90s, the growth process accumulated in a technology boom, which was financed in part by domestic credit and in part by the flow of international funds to the United States in the wake of the financial instability of the 1990s in the rest of the world. Russian crisis, the Asian crisis, and so on and so forth. And that all came to a peak and to an end over a decade ago, in 2000. And I think one can date the opening phase of the present world economic crisis not from 2007, when it accumulated in an economic collapse, but from 2000, when the information technology boom reached its peak. And what happened then? The problem in the American administration was to preserve the appearance and the statistical record and the accounting impression of economic growth, which was done, first of all, by tax cuts, it was done with war spending, it was done by public spending generally, and it was done in the housing sector with enormous increases in the flow of funds to mortgages. And when one looks at what happened in the mortgage sector,